Okay, so thank you to Mike for bringing this up. And Mike, I want to make sure that you're back and that you are listening, since you're the one that brought this up here. And can everybody hear me okay? All right, great. So first thing, and I'm going to set up a scenario here on a whiteboard. Okay, so this is, what's today, the 27th, I think. Okay, so the stock is 37.70. Okay. The 33 call, the October 18th, 33 calls right now are trading $4.70. Okay, as we can see, right here. Okay, yep, I am recording. Thank you. All right, so everybody sees that, right? Because this is the data that we need to have the conversation with. Okay, now, that is parity, right? When we talk about intrinsic, extrinsic value, okay, intrinsic value is what's known as parity. Okay, so parity is the difference between the stock price and strike price, which is also known as what we've talked about. We talked about it a lot yesterday, intrinsic value. Okay? So what does that actually mean? Okay, well, if you break it down, what this actually means is if someone were to exercise their 33 call, exercise meaning literally hand in your option to your clearing firm and get stock back in exchange. Okay, that's what, kind of the literal meaning of exercising an option means. In this case, we're talking about call options. If I exercise my call option, I turn in my call option, and the bank gives me back stock instead. Okay, so if someone were to exercise this 33 strike call, they would be, and I'm going to write this all out because some people, this is kind of a difficult concept. Turning the call option in to their clearing firm, and receiving stock back at the strike price. Okay, everybody gets that? So if I exercise this 33 call, I'm giving it back to the clearing firm. They're giving me stock at the strike price of 33 bucks. Okay, everybody get that? Everybody understand that? Okay, so if I get stock at 33 and the stock is trading, as we set up above here, 37.70 in the open market, the difference is $4.70. The same price that the option is currently trading at. Okay? That is what's known as parity, intrinsic value. And in this case, there's no extrinsic value. There's no premium because it's just, the option price is just trading at that parity level or that intrinsic value. Okay? So essentially, there's no value. There's no value to this option from a premium standpoint. There's obviously a dollar value of $4.70, but there is no premium. Okay? If there's no premium, that means that the put option should be trading for what? I know we're talking call options right here, but if there's no premium in the call option, the put option should be trading basically with no premium either. Exactly, Howard. And if we look, that's exactly the case. It's trading for 3 cents. Exactly, Julie. Okay. So we've got that relationship down. Now, how does this, and this is the reason that I'm going through this, how does this factor in or affect this dividend right here? Okay. AT&T pays a 51-cent dividend on October 8th. How does that affect our option, this 33 strike option? And quite frankly, not just the 33, but probably all call options, if the stock were here, all the way up to at least the 36 strike. Rod, what would rise by 51 cents? Bingo. Okay, Julie, you got it. Okay. Remember, when a stock pays a dividend, when a company pays a dividend, what they're doing is they're decreasing the value of the company, right? They're paying out that dividend amount to their shareholders, lowering the value of the company. So the stock price goes down. Okay. So if we know that in this case, on October 8th, AT&T is going to pay their dividend to their shareholders of 51 cents, then after October 8th, the stock's going to be worth less. Right? Everybody get that? Okay, so if we know it's going to be worth less, what sort of position would you want to have ahead of that? Okay, if you know a stock is going down for certain, what type of position would you want to have? Exactly, you would want to buy puts, or you would want to be selling calls, right? However, everybody knows the stock is going down. So the market, the option market, has to already adjust for that. It already has to factor in that the stock on October 8th is going to be worth 51 cents less. Okay, so that is already factored in to these option prices. Okay, that is already factored into these option prices. The fact that on October 8th, the stock will be 51 cents less. Now, let's go back to the dividend and why these call options, the ones that you have, Mike, and these others that I talked about just about up until the 36 strike, why these options will be in exercise. Okay, when something is in exercise, it means you want to turn your option in to get the stock. Okay, why is that the case here with these 33 call options? Okay, let me go back to the whiteboard here for a second. Why are these 33 call options in exercise? There you go, Sharish. Bingo. Bingo, bingo, bingo. To get the dividend. Now, that doesn't mean that every option that is in the money is in exercise. How do we measure when an option, when a call option is in exercise? It's worth to exercise. Barry, man, you're spot on, dude. You're spot on. When the dividend is greater than the premium or the extrinsic value. Okay. Now, how do we measure the amount of premium, or how do we measure that extrinsic value? Well, we just said in our conversation that Alan, that's exactly what I was just going to say. Great. You look at the put premium, right? Because there should be the same amount of premium in the call and the put option. So if we were just to look at the values of these put options that coincide with the strikes on the call side, we could see that every one of these below the dividend amount of 51 cents, okay, that correlating call option would be in exercise to take advantage of the dividend. Okay, now, let me know if someone is not following along, because I'm bringing in a bunch of concepts here together. Okay? Okay. Let me go back to this question here. Why are these 33 call options in exercise? Because we want the stock, instead of the call option, to collect the dividend. If I don't exercise these calls and I don't get the stock, I'm not going to collect that dividend. John, that's exactly what I'm going to do right now. So I wanted to make sure everybody was on board with me before I do this equation. Okay, is everybody on board with me? John's talking about a mathematical equation that I'm going to put up here that we've talked about before. Okay, the relationship between stock and calls and puts. Okay, so stock equals call minus put. It's a simple equation. Okay, so in this example, if we use stock price of $37.70 equals the call option price, which was $4.70. And remember, this is the 33 call. Okay. Minus the put, which was, 2 cents here. Okay, so what we have is $37.70 equals $37.70 minus 2 cents here. So we have an equation here that is just about equal, within a penny or two. Okay, you can do this with any option, any strike price, the call and the put at the same strike. And this should add up. It should be equivalent. And when it's not equivalent, the reason for that is because there is a dividend. Okay, so if I exercise these call options, I'm going to collect how much of that dividend? I'm going to collect how much? 51 cents, right? So 51 cents is what I'm going to collect, but the put price on that 33 strike is only a couple pennies. Now, why is the put price relevant? Why is the put price relevant to this equation? Well, it is 36.68, Fred. I'm sorry, it's 37.68. Thank you. Thank you, thank you. Let me adjust that. See if I can get this in here. Okay, that's as good as I can get it. Okay, so why is that relevant? Why is the put price relevant? Well, it all comes down to this equation, this relationship between stock and calls and puts. Okay, let me put this up here as page 2. Okay, put this equation back up here. Stock equals call minus put. So if I exercise my call, okay, if I exercise my call, I am really selling the call. Even though I'm not selling it, I'm turning it in. I'm getting rid of it, okay, and getting stock. Okay, well, if I look at this sentence that I just wrote here and put that in terms of this mathematical equation, what does exercising a call option equate to in terms of this equation? What does that equal? Okay, so basically what I'm doing here is selling a call, right? Getting stock. What does that equal? What does a short call, long stock position equal according to this equation up here? What it equals, Martin, is a short put. Right? Does everybody see how that works? This equation right here is the exact same, is the exact same as this equation here. Okay, so Deborah, if I just take my stock equals call minus put, right? And I want to get one side of the ledger to be minus call plus stock. Okay, so if I subtract a call on this side and I subtract a call on this side, okay, which is equivalent in math purposes, math explanation. That leaves me here minus call. Thank you, algebra. Thank you, Kent. Okay, minus call plus stock equals minus put. Does that make more sense? Okay, just as if I wanted to solve algebraically. Okay, that's fair. What would the equivalent of this equation, the stock equals call minus put, be if I just wanted to solve for a long put? Here, we solved for a short put, right? A negative put. What if I wanted to get a long put, a positive put? What would that equation be? What would that algebraic mathematical equation be? Lyle's got it. Okay. If I want to just have a long put by itself, okay, what I have to do is add a put to solve for a long put. Okay, if I add a put to each side of the equation, I would now have put plus stock equals call, right? As step number one. If I added a put to both sides of the ledger here, okay, but remember I want to isolate just for the long put. So then I would just subtract stock from each side. So put equals call minus stock. Okay? But that's not the position we would have by exercising a call. This is just going through the algebra to see the relationship. The exercise going through selling a call, buying stock, leaves us with a short put. Okay, so exercising the call leaves us with a short put. Even though we don't really have the put position, right? We started with a call. We don't have the put position. Theoretically, that's what we are left with. So this is how, going back now, circling back, we identify whether it's worth our while to exercise the call to get the dividend. If the dividend is more than the put, the short put, then it's worth our while, like Barry said. And in this instance, the dividend of 51 cents is obviously well worth it because the put's only a few pennies. And that's why I said, at least as of right now, you would exercise every call option basically up to the 36.5. Because the money you're getting for the dividend is more than the put. Now, in theory, I don't want to exercise them right now. I have all the way until October 7th to decide whether I want to exercise my option. I don't want to do it right now because, maybe if the stock then drops between now and October 7th and I have the long stock, now I'm in trouble. So I have all the way to October 7th to decide whether I want to exercise my call options to put them into a stock position rather than an option position, so I can collect the dividend. Okay, so the bottom line, and I think Barry said it best, is if the amount of the dividend is more than the extrinsic value. Now, remember, the extrinsic value or the premium should be the same in the call and the put. Okay? That's because there's no premium, Deborah. Here it is right here. That's just because there's zero premium. I mean, the puts are trading for a couple pennies, but there's zero extrinsic value. Those call options are 100 delta, meaning they are just like stock. They're just like owning stock. But if I have the call option as opposed to owning the stock, I won't get paid the dividend. Yes, Pamela, that's what we're saying. You have to do that. If I miss that, if I don't exercise this call option prior to the ex-dividend date, okay, so the day before, this, the ex-dividend date here is October 8th, I have to have this into the clearing firm by the end of the day on the 7th. If I miss that window, I will miss out on 51-cent dividend. And how am I missing out on that dividend? Think about it, okay? If I turn it in for stock, great, I have my stock. They're going to pay me the 51 cents per share that I own. If I don't, what's going to happen to the value of this call option the day that the stock pays its dividend? What's going to happen to the value of this option? It's just one day before, Tim. It is one day before. By how much? It's going to go down by the dividend amount. So this call option is going to lose the 51-cent value. I don't want that to happen. So most of your trading platforms will give you a warning. I'm sure it'll pop up on your screen and your trading account saying, you know what, this option is in exercise, or you have a dividend warning. But it's very, very important to understand the dividend process. You could do that also, Mike. Right. If you don't care about the stock, just sell out the calls. Exactly right. Sell them out for, the 4 cent. Well, you're not going to do it right now, or you could do it right now. If you don't think the stock is going up between now and the day of the dividend, then just sell them now. But if you don't care about the dividend, don't care about the stock, yes, just sell the call options out. We don't know really what the max gain would be, Mike, right? Because it's all dependent on where the stock goes. But, If you just sell them out, you'd be closing your position, right? We don't know what that max gain would be. Nobody would. Nobody would, Pamela. Actually, I shouldn't say that. The person that would gain from that is the person that is short this option. Okay? They won't get paid a dividend from the company because they don't have stock. However, if they're short this option through the dividend, well, then they're going to pick up 50 cents in the price of that short option the next day. Okay. What do you want me to write on here? If you are short the call and the person who is long does not exercise before the dividend, then you will make the dividend amount in the value of the call. Yeah, I mean, you can look at it that way, right? If you're getting it, if you're selling out Glenn, right? You're selling it out today at 470. When tomorrow, if all else, if the stock is unchanged, that stock is going to be worth 51 cents less, and the price of that option would be worth 51 cents less. That is correct. Okay. Did this help try to bring this to light? Greater chance of what, Tom? Theoretically, there should be a 100% chance of getting assigned. If you don't get assigned, if by some chance somebody in the world forgets to exercise their options and you escape on it, that's a huge, huge bonus. Theoretically, there should be a 100% chance of getting assigned on that. Awesome. Mike, thank you again. What do you do what, Tom? What do we do with what? Well, if you're short that option and you're just shorted on its own, right, with no hedge against it, then all you're doing is someone is giving you back your call option. Okay, you don't have any further risk going into the dividend being short that option than you did otherwise. Cool. All right, guys. Thank you for listening. Mike, again, thank you for bringing this up. I've got it recorded. Let me get it posted up in the room. Well, that's why we record it, and that's why we use these whiteboards so you can review them. All right, let me get it up here, and I'll be right back, guys. Thanks for your patience listening in.